It is very important that the risk management function is independent of the business, because always the business lines will be interested in the profit, whereas there has to be an independent. That's what the regulators also say, that your risk management support group or the people in the risk have to be independent of the business lines. Now let us talk about risk identification. How the risk has to be identified, because this is a very important stage in any problem solving exercise, whether it is risk or any other thing. Basically the first thing is proper identification of the risk. So what are the risks in the banking business? So whether the depositors bring the risk, or the advance person who is availing the credit brings in the risk. In case of a bank, it is at every transaction level. So all risk, whether we need not go into the details what kind of risk which transaction bring in, but basically the entire risk in the bank gets contracted at the transaction level. This is very important things to understand, because when we want to identify any problem, we need to know where it gets contracted. So when it is identified at the transaction level, and it can be aggregated at the portfolio level. What do you understand by portfolio level? So suppose you have a credit portfolio consisting of different loans given to the different sectors. It is very important that I need to understand the risk contracted at the transaction level and also at the portfolio level, because my portfolio level risk could be different for different portfolios. Then the next step is the aggregation of all this portfolio risk at the corporate level. So that is the third step in aggregating the risk. Now, why risk identification is necessary? As we understood, every activity of a bank or a business always has some kind of a risk. So when an organization has different kind of products and different lines of activity, not that every line of activity will have the same kind of risk. So to make a better analysis of the performance of the different business lines, it becomes very necessary to identify and aggregate the risk at various business lines. And like we discussed earlier, when I am taking risk for running the business, somebody has to pay for the risk I am taking. Though as an owner of the business, I take risk to make money, but at the same time I undertake a lot of risk to deliver my services, whether it is banking, manufacturing, or any other service organization. So it becomes very necessary, because I cannot uniformly price the risk for all kind of activities. So every activity has a different risk profile, and the pricing for the risk also has to go according to the kind of risk which I am taking to run that particular activity. So therefore the risk identification at the transaction level or the portfolio level becomes very important for pricing the risk. And next step after having identified the risk and having priced the risk is to know the performance evaluation of my different business units has to be adjusted to the risk, which is known as the risk adjusted return on capital. So this measure, risk adjusted return on capital, gives me an exact idea as how are the returns related to the kind of risk which I am taking in different business units. Because as we have seen, the risk profile of different banking products and different product lines is not the same. Even you will have a different kind of a credit risk when you are lending to a corporate, and the same kind of risk may not be there when you are lending to a small borrower. So we need to consider that to see whether the business is doing well in a particular kind of an activity. Now when I have identified, the next thing is the risk measurement. Because we know that the kind of risk we take impact my profit or returns from the business. So I need to know the impact of a risk on the expected earnings. This is very, very important. So how do you measure the risk, impact of the risk on the outcome of the business? There can be qualitative measurement of risk. It is purely a judgmental thing of the person who is doing the business. And there are quantitative measurement of risk, which basically will include sensitivity, volatility, and downside potential. Now let us understand what is sensitivity. Sensitivity measures the impact of unit movement of single market parameter in the value of the target variable. What is the target variable? Target variable could be the the impact on the value of the asset. And what are the market parameters? Interest rate, exchange rate, stock price, etc. Suppose you are talking of impact on the profitability of a bank. So the bank's profit could change because of change in the interest rate, because the bank hold lot of investment which are at fixed coupon investments. Bank could also get affected because of the movement in the exchange rate, because bank do keep some open position in the foreign exchange, and bank do invest in the stocks. So if the stock price goes up, if bank is holding stock, definitely bank will make more profit. If at the same time, if the price of the stock which the bank is holding goes down, bank may incur a loss. So basically the sensitivity will tell you what is the impact of a unit movement of a single market parameter. Like we say, what is the impact on the profitability of the bank if the interest rate moves up by 1%. So here that 1% and the single risk parameter here is basically the interest rate, and the value of the target variable is the value of the investments to the extent it goes down. And like we have seen, the net interest income is basically a function of interest rate. So normally the way banks measure the impact on their portfolio is to understand what is the impact of 1% movement of interest rate on the net interest income. How do you do that? Basically the banks will group all their assets and liabilities bucket wise, and just do an impact study. If the rate of interest goes up or down, so what is the impact on the interest income? So if you have more assets which are maturing in a particular bucket, and if the interest rate goes up, what it means is that more assets are available for repricing, so you will get benefit of the increase in the rate of interest. So that is how you have a positive impact on the increased rate of interest. Exactly the opposite is, if you have a negative flow, that means you are in a particular bucket, your more liabilities are going to mature and the rate of interest goes up, the matured deposits will be reinvested at a higher rate, which means that your cost of deposits will go up, which again will reduce your income because of the increased interest cost. And duration to invest portfolio. Duration is an important measure of the interest rate risk. When a duration of the investment portfolio is higher, it is more prone to the interest rate risk. Lower duration means lower risk. Duration we can, very, very layman language is equivalent to the maturity of the investment. If there is a zero coupon bond which doesn't have cash flows in between, the duration is equal to the maturity. So the higher the duration, higher is the interest rate sensitivity. So then mean, variance and volatility are the statistical measures of measuring the risk. We said that the risk is because of the deviation from the expected results. So how do you measure the variation or the dispersion of the actual result from the expected results? The statistical measures for this are mean, variance and volatility. And volatility is also known as standard deviation. Basically this measures the deviation from the expected results. These are all statistical measures. Now let us understand what is volatility, because we talk about volatility in the market. They say the more is the volatility, the more is the risk. So normally the most volatile markets are the one where people either make money or lose money in a higher amount. Sensitivity of target variable can be combined with the instability of the underlying parameter. So volatility measures the stability of any random variable. So if you say the interest rates are volatile, that means the interest rates movements are, there is a upward or downward movement in the interest rates, and it is quite frequent. So volatility is a common statistical measure of dispersion around the average of any random variable like profit, market value, credit loss, etc. So this is the importance of the volatility. So volatility can be in the profit, it can be in the market value of an instrument, or it can be in the way the bank's NPA or credit losses. Volatility is the standard deviation in the statistical terms. There are two types of volatility. How do you measure volatility? Volatility we can say based on the historical experience. Suppose I have a record of all the profits out of a particular portfolio, and if I measure those returns on a daily basis, I can find out the kind of a historical volatility. What the historical volatility gives me is the kind of the movements a particular variable has seen in the history. Is it useful? Definitely, because most of the risk management experts use the historical volatility to make an assessment of the likely impact in the portfolio in the coming days. There is a forward-looking volatility which is known as implicit volatility. Implicit volatility measures the kind of volatility which is expected in the future based on the option prices. Why option prices? Options are basically to cover the risk in the future, and basically the implicit volatility is derived from analyzing the kind of the movements or the movements which is reflected in the option prices, because all the options are priced considering the expected volatility in the future. So that is considered to arrive at the forward-looking volatility. Now volatility and the relation between the time factor. So volatility can be measured on a daily basis by calculating the changes in the price on a daily basis. Like yesterday the stock was say 101 and today it is 102. The volatility will be 102 minus 101 divided by 101. So that's the kind of we say that the prices have changed over a day to this extent. And the same thing we can do periodically also. We can also measure the volatility by measuring the week to week changes. If the price is 100 at the end of the last week and it has become 101 this weekend, so we can say that the week to week volatility is 101 minus 100 divided by 100. So that is how we measure volatility over the day, or the 10 days period, or weeks, depending on the kind of data which is available. Now what is the relation between the two? If you want to know the volatility over a time horizon T, basically if you know the daily volatility, the rule is suppose you want to get the volatility over time period 10. Let us try this on the board. Suppose daily volatility is 0.03, to compute volatility for 10 days, The formula is daily volatility 0.03 into square root of 10. So that is how we compute the volatility for 10 days. The same thing we can, even if you want to know what is the volatility for 365 days, you can multiply the daily volatility into square root of the number of days you want to compute. So that is the relation between volatility and the time horizon. Now, very important part in the business is to know the downward potential. Let us also understand the concept of VAR, what is value at risk. See, as you know, business or the bank are more concerned about the downward potential than the upward potential. We know that the upward potential will always brings more money to the organization. So we need to worry more about downward potential when you talk about risk management. So what is the downward potential? We know that the volatility captures both upward as well as downward potentials. So basically the upside and downward deviations from the expected results. So the downward potential has two components. The first, when we say we are likely to incur loss, and we are lending, say suppose we are lending to 100 customers. Then the first thing we need to know is what is the probability that there could be losses, or what is the probability that out of this 100 people, how many people actually will default or will not pay back the money. Then the next thing we need to understand is if there is a loss, or if suppose one person fails out of 100, what is the impact on my profit, or what is the downside, what is the expected loss which I am going to incur. So if we know both of these, then only we can know the downside impact or the downside impact of the potential risk. Downside potential is the most comprehensive measure of risk as it integrates sensitivity and volatility. That is what it shows. The volatility comes out of the potential loss, and the sensitivity comes out of the probability of occurrence of downside. Now, what is VAR? Value at risk, as it is defined in the risk parlance, it is the maximum amount of loss a business can lose over a given period of time with a certain level of confidence. So it is not exactly the quantification of the loss. It is just a measure of the downward potential. So we should not always confuse VAR with the actual loss. Now, having measured the risk, now next thing what the business has to do, whether it is banking business or any other business, is to try to recover the cost of the risk from the users of the service, right? And for that there are two components. What is that which absorbs the risk? Capital is the one which is most important, which absorbs the loss, right? Capital works as a cushion for loss absorption. So basically one of the important thing any business will require, whether it is profit making or not, is capital. Capital is, what is capital? Capital is the equity, or it is the owner's contribution, or it is the business own money. And when we are saying the capital works as a cushion for the risk, then when you are saying pricing a risk, we need to load the cost of capital as one of the component of the risk pricing. And the next thing is the risk premium. Like we discussed, different activities have different kind of a risk profile, and each risk or the risk profile, different risk profile means different risk pricing. So that is where the second component comes in. So first is the cost of capital and the second is the risk premium, and risk premium will vary depending on the kind of activity.